Hey traders, welcome back. In this video, we're going to dive into a couple of the very powerful indicators that are going to give us a deeper understanding of the volume and price action. And when we use these together, they can help, spot high probability trades by showing where the big players are active in the market. We're also going to get into the setup of TradingView and how I set my TradingView up to analyze the market and prepare myself to take trades while using the fair value gaps. So let's get started. So here on my screen, I just have a single layout, a single chart of QQQ. Now I want to stress that when I analyze the market, I'm not just looking at one particular indicator. In my earlier trading days, when I used to trade SPY and or QQQ or any other tech stocks like Amazon, Tesla, Nvidia, those are all great tech stocks to trade. However, it's in my opinion that when you just look at that particular stock and you're not looking at other important tickers such as QQQ, SPY, ES, and NQ, as I like to call it, you're basically trading blind. And the reason why I say that is because a lot of these tech stocks all follow the market. So when you're looking at QQQ, SPY, ES, and Q, it's going to give you a better insight of what the market's actually doing. So if I were to trade Nvidia today, there's absolutely no way in the world I would take a trade on Nvidia, regardless of what just the Nvidia chart says, without looking at the rest of the market like NQ and ES. Those are so important and so crucial that I need those in order to guide my trades. So in this video, what we're going to do is we're going to set up a layout that will contain 4 different charts. It will contain SPY, QQQ, ES, and NQ. And the futures are so important that we have to look at those. It's providing data that goes outside of the after hours trading session, and we need to be able to see that data because that data, when QQQ and when QQQ and SPY stop trading for the day, there can be fair value gaps that are actually created on ES and NQ that we may not even be aware of if we're not looking at them. And price can react there. So a lot of times, if the market just makes an impulsive move to one direction and we have no idea why, it's likely because it's a move that occurred on ES or NQ, and if we're not watching that, we're going to be caught off guard. So let's get into the chart. So first things first, I want to set up our layout with our 4 tickers that are extremely important for us to look at. So we're going to extend beyond just QQQ here. Now we're going to go ahead and click this button here to create a layout with 4 charts. Now I believe that when you're using TradingView, you're going to need a specific plan in order to have 4 charts. I have the middle plan. I believe it's $24.95 a month that allows you, 4 charts. There's another plan or membership that's a little bit higher. I don't think that's necessary, in my opinion. The one below that, which I think is $9.95, I don't have the prices in front of me at the moment, but I don't believe that that's going to allow you 4 charts. So in my personal opinion, if you want to set this up the way that I have it set up, you're likely going to want to go with the middle tier, and that will give you several indicators, more than what we need for this setup, and the 4 charts. So going back to the chart here, we're going to go ahead and select this one here. This is going to give us a layout of 4 different tickers. Now the way I typically have mine set up is I'll have SPY here first. So we'll set that with SPY, and then we're going to hit QQQ, And then we have ES here, third one, and NQ. Okay, so we have NQ already set there. Now, I already have some zones and levels already set here. So if you don't mind, I'm just going to go ahead and remove all these drawings so that we can start fresh. So we're just going to remove drawings across the board on all four. Okay, now we're going to start fresh here. Now, as you can see, there's fair value gaps that appear to be displaying on some of these tickers. We're going to get into the two indicators that I referred to at the beginning of this video. And the first one is our volumized fair value gap. Now, as you know, I talk about fair value gaps all the time because it's all I trade. That's my strategy is looking for fair value gaps, looking for the liquidity, and taking trades off of those areas. Now, when fair value gaps are talked about, many traders that don't know anything about fair value gaps are under the impression that you have to find them. Now, it's true that if you don't have an indicator, you'll have to spend time on the chart and look for fair value gaps, and that can be quite tricky. However, there is an indicator that's available to us that's extremely powerful. And, you know, I had come across this one day while watching a YouTube video. When I started learning about fair value gaps, I heard all of this hype about fair value gaps, and I started to you know, research. And I was watching a YouTube video one day, and I had come across this fair value gap indicator on TradingView, and I began using it, back testing it, you know, just looking to see if price would react off of these levels. And I was just highly impressed with how effective, number one, the strategy was, and two, like the actual indicator. And it not only does it show the fair value gap, but it also has some metrics, and we'll get into that. One of the key metrics is the volume, and we'll talk a little bit about that. So first, let's add this indicator. So if you don't have this indicator in your chart, let's get that added. Ensure that you have your four. I'm sorry, I just realized that this is not ES. There we go. Okay, so now that you have your four tickers, the next thing we want to do is get the indicator on there. So we go up to indicators, and we can just type in volumized, okay? And it'll be called volumized fair value gaps, okay, by Flux Chart. This is the one here that you want to add, okay? So you want to make sure you add that across. Now, just to show you a little trick if you're not aware, if you add it to one of your tickers, say you just added on SPY, but it's not on the remaining ones, you can just right click that particular chart and say, apply these indicators across layout, and it'll just apply it to the remaining three, so you don't have to individually add it, okay? And it'll also copy the configuration too. So if you make configuration changes to this one indicator, you can just do the same thing, apply this indicator, and it'll apply the configuration across the entire layout. So it saves some time with not having to do that to each individual ticker. And the next indicator that we're going to add is called Lux Algo Volume Delta Candles. So we can search for volume delta candles, and this one here, volume delta candles by Lux Algo. We're going to add that. Let's talk about each of the indicators. So the first one is the that we're going to get into is the volumized fair value gaps. And what this indicator does, number one, of course, is that this is going to display their fair value gaps on your chart. You literally do not have to do the work on your own. I mean, it's showing you where the fair value gaps are, and it's your job and your duty to then look at price action. You don't just wait for price to come into that level and take a trade. You have to look at volume, look at candlestick patterns, and do your due diligence before you take a trade. But this is actually just doing the work for you, where it's showing the fair value gap for you. Okay. Now, one of the things that this thing does is that it tells you the total volume and of how much trading activity happened within that gap. And what that does is it helps us identify whether that gap is significant or not. And then what we can do is we can take that metric, that volume metric, and on SPY, we could see that there is 9.4 million. That's the volume of that gap. We can take that data and we can compare that volume of the fair value gap to the candles around it, and that'll help us gauge the strength of that fair value gap. So what we do is we look for high volume fair value gaps in comparison to the surrounding candles. Now, if you're on the 4-hour chart like we are right now, there's 9.4, the volume of this is 9.4 million. So the volume that's around these, you'd have to compare. So if 9.4 created the fair value gap, then we look at other candles surrounding it. And the idea is that you want the volume of the fair value gap to be approximately 2 to 3 times larger than what's around it. Now, where does that metric come from? Was that just made up? Did someone say that? No, that's what I have found through my investigative work, my research, is that when I find that it's anything 2 to 3 times more or more, right, then that will help determine if it's strong or not. Now, if we see, just around this, if candles that are around the fair value gap around the same volume as the fair value gap, then that's indicative that that fair value gap is not very strong. And of course, we'll still wait for price to come into that zone to see how it reacts. But knowing that in advance, I have a trade plan in advance. So I just don't, when I'm trading during the day, I'm just not, just impulsively taking trades. I have a plan in my head. So in the morning, I see a fair value gap. I plan on taking a trade off of that fair value gap. So I just simply sit back, wait for price to move into that fair value gap. And then I make a determination whether or not I'm going to take the trade based off of price action, based off of volume. But if a fair value gap doesn't have a lot of volume, then as price approaches it, I have in my head that I know it's not very strong and that price could pierce through that fair value gap. Now, of course, I'm still ready to pull the trigger, but I'm not very confident that that fair value gap will hold up just because of the volume itself. And again, I have to still analyze price action to make my final decision on whether or not I want to take the trade. Okay, so that's the most important aspect of, or that feature, I should say, of that fair value gap indicator is the volume. So again, we're taking that metric, then we're looking at other candles around, the previous candles around to see what they are. So if they're around 3 to 4, that's about 2 to 3 times the volume of the fair value gap. That tells me that's a pretty strong fair value gap. So when price does go back into that zone, I'm ready to take the trade, but of course, based upon price action. So that's the first indicator. The next indicator is what's called the volume delta candle. And the volume delta candle indicator, you can see that my candles are looking a little bit different than they would if I have my standard candles on, right? Your standard candle is a red candle, a green candle, right? A red candle indicates that price opened at level X and it closed at level Y, which is lower than where it opened. And the green candle is just the reverse, price opened at X, closed at Y above the opening price, which makes it a green candle. It's interesting because talking to other traders in in my trading journey, there's a lot of traders that actually don't even know the anatomy of a candlestick. And that's, a little discouraging. And, I find that very, I'm surprised that, when people see candlesticks and a red candlestick, they just think red, it's bearish, green, bullish, but they don't understand the anatomy of it and how a green or red candlestick's formed. It's super important for price action and knowing that, because there's psychology behind every single candlestick. And I like to say that, reading candlesticks it's like learning a new language, right? Every single candlestick is telling you something. It's telling you something. It's the market is literally telling you everything that you need to know. You just need to know how to read it, right? And that's why, like, I as a trader, I don't really use indicators. Back in the day, I used to use a number of different indicators: RSI, MACD. I'm using Bollinger Bands, and I'm using this stuff. But to me personally, I think that all of those indicators can be helpful, but the way I trade, those indicators would be absolutely useless to me. Okay, because I'm not using like lagging indicators. I'm just looking solely at price action. I'm looking at volume and I'm looking at the candles, and that's in price movement, and that's how I make trading decisions. So the reason why we're getting into the candlestick talk is because we want to say that this indicator shows these candles or displays these candles a little bit differently than what we're used to seeing. So when we turn this back on, we can see that these candles are hollow. Some of them have a little bit of green, some of them have a little bit of red, some of them are completely red, and some of them are completely green. So this volume delta, right? This is a feature within the indicator. And the main feature of this is the volume delta, which tells us how much more buying or selling volume occurred within that candle. So positive delta means there's more buying displayed in green, and the negative delta shows more selling, which is displayed in red. So what we look for when using this indicator is that a strong positive volume delta on a bullish candle would confirm buying pressure. So if we see like green, that would imply that there's more buying pressure on that particular candle. And then a negative volume delta on a bearish candle confirms strong selling. And that's part of like the coloring. So the bar coloring helps you, visualize the strength of buying and selling within each candle. What it does is this indicator will display this as a, full bar, half bar, and tell you whether or not buyers or sellers dominated within that particular candle. So what we look for is, for example, if a candle is green, bullish, but has red delta, which would mean more selling volume, that can indicate weakness and a potential reversal. So yes, like a red candle can have green in it, or a green candle can have red in it. That's just showing if there's strength or weakness, or if buyers or sellers dominated in that particular candlestick for that time frame. That's a second, that's a second feature. The next feature is the highest volume at a particular price level. Now this is what I really use, and this is pretty awesome. So what this does is it highlights the price level within a candle where the most trading volume occurred, and that gives you a key price level to watch. Okay, so when price comes in to a fair value gap, okay, now I'm just using this QQQ as an example, right? It didn't come into the fair value gap, but you can see this horizontal line here. That indicates where price, that's where the highest price level was for that candle. So at 564.26 was where the most amount of volume was traded for that particular candle. Now, why is that useful? Well, when price is going into a bearish fair value gap, or price is going into a bullish fair value gap, and we see that horizontal line at the level, the key level, and then we see price pushing away from that zone, That is a very, very key aspect, because that is telling you that if price is, if you know the highest volume is traded at that area in the zone, it's almost a dead giveaway. Now, I'm not saying that just because you see that horizontal line in a key level that's going to mean that price is going to go to the moon or go to the floor, but I can tell you that that is a feature that you have to utilize, because not only does the candle give you, a dead giveaway along with volume, right? So let's just say for instance, price moves into this fair value gap. Okay, we see price move into this fair value gap and we're looking for the rejection. Okay, and we see this type of candle where the horizontal line is in the zone, and we see this type of candle on increased volume. That's a trade I have to take. Okay, that is a trade that I have to take. Why? Is because look, we see that pin bar, candle off of the moving away from the zone. That implies that, thinking of how the candle's formed, right? The price opened up in this here. Buyers push price into the level, sellers push price back down and closed below where price opened. But to me, it's not really a question of whether or not price opened or closed below where it opened, because this could even be a great candle. It could have closed above where it opened. But what's, to me, in price action, what's important is that price was pushed up by buyers, but sellers pushed price down, and the volume is so important. Okay. And then on top of that, having the visibility to see where the most amount of volume was traded in that candle. If you see it above price on a rejection or below price on a bullish fair value gap where price is being pushed up, that is absolutely key. Okay. So these are the two indicators that we are specifically using, to trade the fair value gap. Now let's go back to the volumized fair value gap indicator, and I want to show how I set this up, because there's fair value gaps that are displayed on multiple time frames. So what I do is I mark these out so that we can see these across all time frames. So I like to look at the 4 hour, 1 hour, 30 minute, 15 minute, and sometimes I'll look at the 5 minute fair value gaps as well. But let's go through all of them. Okay. So we can see here that I'll go ahead and expand SPY. We're going to start with SPY. Okay, we're going to work on SPY here. So what we're going to do is we're going to draw rectangular lines. What I do is on a fair value gap, there's two sides of it, right? Typically, price is going to either react right at the entry zone of it or the median, right? The median is very strong. I see reactions off the median all the time. Usually when price starts to pierce through, I lose confidence in that fair value gap. But if I still see strength off of that other side, then I still look to take positions, but it all depends on the price action that I see in volume. But really, on a bullish fair value gap, this first half is where I'm really looking for the reaction. Okay. So what I do is on the 4 hour chart, I'm going to go ahead and mark this out. So I go ahead and grab the rectangle tool. Okay. And I'm just going to draw a zone. Okay. And I draw a green zone. So, and I like to be very precise with these. So I am going to go exactly to where it starts to the median. We're going to change the color of this to green. Okay. And there's a green. Now, what I do is I draw a horizontal line at the median. I always do this. I draw a red line at the median. That way I know that that's the median of it on a different time frame. Okay. And then that bullish fair value gap is complete. Next thing I do, this is a bearish fair value gap. So I'm going to do the exact same thing. Okay. We're just going to make this red. So I will bring that to here. Make this red. Whoops. Okay. And I draw my red line there. Make that right about there. Okay. And there's our two fair value gaps. One bullish, one bearish. Okay. So that's the 4 hour. Now we're going to go to the 1 hour. Now, as you can see, On the 1 hour, the indicator is not going to display the 4-hour fair value gap because we're not on the 4-hour fair value gap. So now we're going to look at the 1 hour, and then we're going to do the same thing. So we're going to mark these out. Okay. So we're going to do the same thing for these. Okay. There we go. And we're going to do this one last one up here. And we're going to draw our horizontal line. Now, in the interest of time, we'll go through, what you'd want to do on your chart is go through the 30-minute, 15-minute, 5-minute, and they're going to see that there are a lot of fair value gaps. Now, here's what's important. If they're really far up, I may not add them right away because price is down here, so I can worry about this later. If price starts to move up, aggressively, then I'll start adding this one up here. But just to prevent clutter on my chart, these are really the ones that are important to me. Okay, now perhaps I'll add this one here, but this is on my demo chart. If we go to my real chart, this is what I have in real time. Okay, now, so this is what we expect to see across all 4 tickers: SPY, QQQ, ES, and NQ. All right, now, the next thing that we want to do is mark out, after we've completed all of our bullish and bearish fair value gaps across the market, we want to then add previous day high and previous day low. So many traders don't realize how price react to previous day high and previous day low. I mean, they create trading opportunities like you wouldn't imagine. Okay, you have to put that on your chart. If you don't have previous day high and previous day low on your chart, please add that. I'm a fair value gap trader, but there's days where there's the fair value gaps, or I'm sorry, previous day high, previous day low, where price enters those zones, and I take trades off of them. And a lot of times, furthermore, previous day high and previous day low will be within a fair value gap. So that's the confluence that we want to see, right? Because not only is it a fair value gap, which can, present a great opportunity to take a trade, but previous day high is right within that. So that's 2 things within that zone that help make that trade a higher probability. So whenever I see previous day high, previous day low in a fair value gap, given that I see the correct price action that I'm looking for, best believe I'm taking that trade. Okay. So we go back to my demo chart. We showed that, we have all 4 tickers, and then we want to add previous day high, previous day low. So just to show you how I would draw this out, because I already have it drawn out on my active real chart, I'll just take the rectangle and I look for previous day low. And, I think there's really an art to creating levels and zones. Now this is on the 5 minutes, so I kind of look at the 5-minute, 2-minute, 3-minute, and see how the bottom candles, wicks, and all kind of align in order to kind of draw this zone correctly. So what I'll do is I'll probably draw it to the bottom wick of this red candle right here. So it grabs the low of the day, and then I'll take out the bottom wick, and that's going to be my low of day. Now what I do is I don't make these red because my red zones on my chart are for bearish fair value gaps. So when I see red, I know that those are bearish fair value gaps. So what I use is purple. So purple for previous day high, previous day low. My entire zone is going to be purple, and that way I immediately know that that's previous day high, previous day low. Now what you can do is just copy that, Control C, Control V, and then that's going to, whoops, I don't think I did that. Control C, Control V, and it didn't work again. Control C, here we go. And then we draw our previous day high. So I take price, and boom, there's our previous day high. Now I can move that down maybe a little bit, maybe to, I don't like to make these zones too wide, but I think that will suffice right there. So there's my previous day high. Now I only do previous day high and previous day low across QQQ and SPY. I don't put them on ES and NQ because realistically SPY is ES and NQ is QQQ. So if I see price go into previous day high, let's just say on QQQ, NQ is going to react there anyway. So I don't need to. It'd just be redundant to add it on ES and NQ. So I don't add them to the futures. Of course, what I do add on futures is the zones and the levels, but I don't add, I'm sorry, the fair value gaps, but I don't add previous day high and previous day low to ES and NQ. So the futures, we're just subtracting that, okay? Because we have that marked on QQQ and SPY, and that will be sufficient. The next important thing that I want to point out is when we're doing these fair value gaps, if you realize that your fair value gaps may not align with mine, on QQQ and SPY, make sure you have extended hours on there, okay? Because if you have regular trading hours, they may be completely different. And the reason why I use extended hours is because it's going to give you that extended hour data, right? Fair value gaps can be created in that extended day. And if we don't have that on our chart, then we're just missing information that we need. So I use extended on SPY and I use extended on ES as well. Okay, I'm sorry, on SPY, and I have extended on QQQ as well. I apologize. So this is the setup. Okay. Now to kind of recap, what we do is we draw out the rectangles for bullish and bearish fair value gaps across the 4-hour, the 1 hour, the 30-day, the 15-day, and the 5-day. And you can add the daily if you'd want. You know, I'm a day trader. I don't typically swing trades. So those higher time frames can get a little tricky. But if you're a swing trader, you know, using the daily, the weekly, even the monthly fair value gaps can be very beneficial and provide, you know, high valuable trades for swing traders, or, you know, if you're buying leaps. But for me as a day trader, I'm looking for quick impulsive moves, scalping, getting in and out of trades. I use, you know, those time frames, the 4-hour, 1 hour, 30-minute, 15-minute, and 5-minute. So we added the fair value gaps on our chart across all 4 tickers. We added previous day high and previous day low to SPY and QQQ. And the last indicator that I have is I use the daily simple moving averages, okay? Because they're very important and price typically react off of those. Now, I will say that I personally do not take trades off of the daily simple moving averages. I know that the market can react to those levels, but I will not take a trade simply off of that moving average. But what I will do is if, for instance, that simple moving average is within one of my key areas, like if it's at previous day high, previous day low, or it's within a bullish or bearish fair value gap, then that will add confluence to that area, right? Because that's going to bring a potential higher probability setup, because not only is it just a fair value gap, but it also has, you know, your daily simple moving average. Okay, and the name of this indicator is called, you can just search for DSMAs, DSMA, and there's your daily simple moving average right here. It's this one here, Immortal Freedom, I believe it is. Let me just double check to make sure that that's the one. I'm pretty sure about the script. Oh, nope, oops, wrong one. Daily simple moving averages, about the script. Yes, Immortal Freedom, yep. And what I do is let's get into the settings on these indicators real quick too. So the daily simple moving average, I have the 20, 50, 100, and 200. So those are the SMAs that I have. I don't have the 10 on. I just don't see any value in having that one on, because I've just noticed that the market doesn't typically react to that. Now the settings on the volumized, okay? So the zone invalidation I use is the wick. What does that mean? That you mitigate the fair value gap when price moves to the opposite side of it, right? So when it, even if it's just a wick and it wicks to the other side of a fair value gap, for instance, if price moves up through this fair value gap in you know, the wick, it wicks and then comes back, as long as the wick is over the other side of the fair value gap, it invalidates that zone, and therefore it doesn't display the zone anymore. Okay, so the zone will just the zone and the fair value gap will just disappear from your chart because it's basically considered invalid. It's mitigated, so it won't show it anymore. So it's the wick. Now you could set that to close, which means that it has to close to the opposite side, but I don't have that set that way. Uh, why? This is just the default configuration that I've used, and it seemed to work just fine. Zone filtering I have set to average range. You can look at the script's information to kind of understand how this fair value gap can be optimized or changed. Look at the configuration to better understand it. I have it set to average range, which is the default. You're welcome to change to volume threshold, but I have it set to average range. This doesn't apply because I'm not using volume, so this setting doesn't apply at all. And then fair value gap detection is it have to be all the same type of candles, or on a bullish fair value gap, you have 3 bullish candles to create that bullish fair value gap. So it detects that fair value gap based on the same type of candle. Whereas if you set this to all, this would mean that it would capture a fair value gap, a bullish fair value gap, if it had 2 bullish fair value gap or 2 bullish candles and 1 bearish candle, it would still detect that fair value gap. So the way I have it set up is the default, which is to use the same type of candle. Have I done any research or done back testing on the all so that it captures of the 2 different types of candles? No, I have not. I suppose I could, but I don't feel the need to because I like the way that the fair value gaps are detected in my current setup. If I could go back and check to see how that looks, but I don't feel that it's quite necessary. And then the next one is the detection sensitivity. Now you can have this set to low. It's set to low or normal by default. I have mine set to extreme, so that means that it will find more fair value gaps. Now I had this set to low at one point in time, and I was using it, and it was very, very effective. But then I moved it to extreme, and I see that when I had it set to low, and I had a bullish fair value gap, say for instance down here, and the next a bearish one's here, bullish here. I would see some activity in between, some pretty good market reaction, and even across the board. I'm watching where prices across the board. I wouldn't have a fair value gap across the board on any of the tickers, but I would see it all reacting at the same place. And then when I turned on the extreme, I was able to see why, is because there's other fair value gaps within there that I didn't have, or that my indicator wasn't detecting. So I set it to extreme because although it may show you more fair value gaps, I actually rather have them on there. That way I can see where the price can react. And I know that, if I'm in a trade, I know that, here's an area where price could just bounce right in my face. And I have to be able to know that. So I have it set to extreme. You're welcome to play around with the different sensitivities and see if, the low works better for you, or if the extreme is helpful and effective for you. That's completely up to you. It's a preference on how you want, how frequent you want your fair value gaps detected. And lastly, the last thing I have on here is just to show historic zones. If you check that on, it's going to show fair value gaps from from previous going back in time. Now, is this useful? Well, yes and no. And the reason why I say yes is because some of the higher time frames, and this is going to be kind of outside of the scope of this video, but the higher time frame, like a 4-hour fair value gap, if it's a major fair value gap, there's a lot of volume. It's a fair value gap where I'm very confident price will react of. Eventually, that's going to get mitigated, right? Eventually, price is going to go into that and absorb orders and all. And price is going to go through that zone. Again, outside of the scope of this, but those, if you have a bullish fair value gap, once it's mitigated, that can become an inverted fair value gap trade. And what I mean by that is just like support becomes resistance, resistance becomes support, right? Like break and retest. It's the same thing here, where when it comes back into that area, that can present a short opportunity. So again, if you have a bullish fair value gap that gets mitigated, right? So price, comes through, bounces, holds. Eventually it's going to break through it, right? And it breaks. Now, if price comes back into this area, it can present a short opportunity. And that's where you can, if you want, display your historical ones just for the higher time frame ones. I wouldn't, mark out historical for 5 minutes because your chart is going to be a complete mess, right? And the idea for me is to have a clean chart. And although my chart may not look clean to you, I'm very well aware of what I see, and because I'm very used to, um, how I trade. I'm very used to how my chart's looking this way. So to you, it may seem, you know, a bit overwhelming, but I'm very familiar with what I see, and I wouldn't, if this is a lot, then by adding historical zones on lower time frames, probably, and marking those out, can, especially if you're putting them rectangles. Now, if you're just displaying those, where, if you want to just display historical zones but not actually mark them out with the rectangle, that's completely up to you. But just know that those higher time frame ones, the whole point is that they can present, inverted fair value gap trade opportunities. So, like I said, a bullish one that gets mitigated, that can present a short opportunity. Okay. So that was the last setting on the volumized fair value gaps. And lastly is the volume delta candles. I have everything set to default. I have never touched any of these. And again, the most important thing that I look at really is the horizontal line. That's it. That's really what I use it for mostly. So if price were to come down in this bullish fair value gap here, and I were to see a candle, bullish candle pin bar, like exactly like I'd want to see high volume, and then I would see the rectangle, right on the edge of this fair value gap, I'm in. I mean, that's just a trade that 10 times out of 10 I have to take that trade. If I were to lose on that trade, then so be it. I'll still take it next time I see it, because that's just telling you clearly that, you see the price action that you want to see, you see the candlestick pattern that you want to see, or the candlestick you want to see, you see the volume you want to see, and then you see price, the highest volume, the most volume was traded below where the current price is, and it's in that zone of a bullish fair value gap. Again, if I lost on that trade, I'll take it again, an hour from then, because to me that's just a high probability setup that I'm not going to walk away from. So let's kind of recap here and summarize. Today in this video, we discussed how to set up our TradingView across the market. Now, in some of the material I provide, I talk about NVIDIA as well. NVIDIA is very, very important. It's, we all know it's the hottest stock in the market right now. It heavily influences the market. You can add NVIDIA in here as well if you choose to. I have a fair value gap tech chart that I use, and I look specifically at NVIDIA. You can add that if you choose to, okay? If you choose to do that, you're welcome to. The interesting thing is that if NVIDIA goes into a key level, whether it's a bullish fair value gap or a bearish fair value gap, believe it or not, if it reacts off that, it's a very good chance that the market, like QQQ, SPY, ES, and NQ, will do the exact same thing. There's people that argue with me that that's not true. Hey, to each their own. We all have our own opinions, right? I just go by what the chart tells me. Okay, I don't care about sentiment. I don't care about, he said, she said nonsense, right? I go by what my chart tells me. And if I've seen over and over again that NVIDIA goes into a bearish fair value gap and it rejects hard, I can just take a trade off of QQQ and be confident, even though QQQ is not even in a key level, but I can likely be confident, as long as I see the same price action on QQQ that I see on NVIDIA, that I can take a short and then target either the next key level on NVIDIA to take profits on QQQ, or the next key level on QQQ, or across the market, because that's how I trade. Now, the next in upcoming videos are going to talk about how exactly to trade these. This was more focused on the setup of it, but we'll talk about how to actually do the trading, and how to take these trades, what to look for, the price action to look for. But what I can wrap up and say uh, in this video is that you're looking at this across the market. You want to look for price to move into a fair value gap. Now, does it have to go into a fair value gap across all 4 tickers? No, you don't. But when it's interesting, because price will typically get pushed into fair value gaps across the market at the exact same time. I don't think it's a coincidence. It just happens that way, but you'll literally see price move into a bullish fair value gap on SPY. You'll see it go in on ES, because they're the same, and you'll also see it going on NQ at the same time. And when you see that bearish, that pin bar high volume, I can't stress enough, you have to take the trade. You have to take it. You can't be scared, because if you're scared in the market, you shouldn't be trading in the market. Okay, you have to be confident in what you see. Our brain is a muscle. It's muscle memory. When you see the same movement over and over and over again, you take that same trade over and over and over again. When you see it, when your brain sees it, it's going to recognize that you've seen it before, and you take the trade. So I'm looking for price to go into fair value gaps. I typically stay away from trades where there's a bullish fair value gap right below where price is, and there's a bearish fair value gap right above price, because I have to assess risk to reward, right? If the risk to reward isn't in my favor, I'm not going to take the trade, right? It's a no trade zone, which I say, because I'm not going to short into a bullish fair value gap. In other words, I'm not going to short into demand, and I'm not going to long into supply. So I'm not going to take a long position if there's a bearish fair value gap right above me. Now, this is more of an advanced topic that we can talk about in later videos, but sometimes that may be that may be justified, because if you have a bullish fair value gap and a bearish fair value gap that are sitting, right on top of each other, then you can look at the volume of each of those to determine which one's weaker. And if there's one weaker than the other, then you can look to for price to go in that direction and potentially pierce through that. Do I advise that technique or strategy? No. One side's going to break, right? The bullish fair value gap's going to break, or the bearish fair value gap is going to break. So I wait for that to happen, because I'm not willing to risk taking a trade into a fair value gap. I risk, I'm taking trades at fair value gaps to move away from the fair value gap, but I'm not going to trade into a fair value gap, because given the fact that I know how price reacts off of them, they're impulsive moves. So you guys got to be ready. And at least you being able to see the full picture across the entire market using your futures, you guys will have a very good understanding of what price is doing. Once you have this set up and once you start using this, trust me, I have a lot of confidence that with this particular setup that we have right here in front of me, that you guys will have better clarity on the market, better trader opportunities, better clarity, and you'll know when price is trying to do something specific, like catch longs, catch shorts. You'll be able to see it. I tell some traders, try to warn traders that if there's a fair value gap, but price is moving up aggressively, and it looks like a move to the upside, which people start jumping in because they see it. They see a quick pullback. They say, okay, here's my pullback, long position. I'm jumping in on calls, but they don't realize that there's a bearish fair value gap sitting right above where it is. And I try to warn folks because they don't have it on their chart. So they don't have the fair value gaps on their chart. They have no idea that there could be a major reversal. And I watch price go right into that fair value gap. I'm taking the short while they're riding long positions, and things don't go too well for them. So anyway, that's what I have for our video today. We talked about the volume delta candle. We talked about the volumized fair value gap. We set those indicators up across SPY, QQQ, ES, NQ. We added our daily simple moving averages across the board. The delta volume candles displays the buying pressure and selling pressure within a candle, which we typically can't see without that indicator. And we also have the ability to see where the most amount of volume is traded within a particular candle. That is very key. And we talked just a little bit about, how price can, essentially their price are just moving from one fair value gap to the other. That's all the market's really doing. We'll get into the trading of these fair value gaps, and you'll be able to be confident in taking these trades. When I started trading the fair value gap, I can tell you with all honesty that I've never had a strategy that was so effective and had given me the clarity that I needed on the market. I had gotten clarity when I started using ES and Q, at least by charting supply and demand zones, and that gave me a lot of clarity. But there were times where the market would just react at levels I didn't have on my chart. But then once I had the fair value gaps on my chart, I can say that 99.9% of the time, if there's an impulsive move, it's off of a fair value gap. I rarely ever get caught off guard, and the people that I see like on various social media platforms, they're hooting and hollering about the market's rigged, the market's manipulated, it's a scam and all this stuff. I say those are the people that just that's the excuse for you losing in the market. Those impulsive moves are not just happening out of nowhere. Those impulsive moves are literally happening off of fair value gaps. The chart, I mean, you guys can see it, right? This chart is literally showing moves going right into fair value gaps and impulsively moving down, right? That's all this is. I mean, it's just moves into fair value gaps. Another one, boom. And they just move from level to level. And each time there's a big move down, it just creates a new fair value gap. And, price will eventually move back into those for other trade opportunities. The clarity is unbelievable. Use it, guys. If you have any questions about anything that we went over in this video, be sure to, comment on the video, and I'll do my best to respond as quick as I can. I really hope this video was useful. It should give you the ability to set yourself up with everything that you need. Just make sure you have on your extended hours, and you can go into Monday and just sit back, maybe not take a trade, and just watch price and see where it reacts. Make sure you have all your fair value gaps all marked on your chart. If you want to put the 2 minutes on there or 3 minutes, you're welcome to do so. But just watch where price reacts. You'll be very surprised. Thank you again for tuning in, and I'll be sharing some more content soon. Take care.